The market's been on a bit of a tear yesterday. Looks like it's going to open up similarly after what has been quite a ride in terms of what we've seen out of earnings this quarter. Of course, the question is it going to continue? And as we continue to talk about inflation, we're watching Bitcoin moving higher this morning, partially as a result of that potential futures ETF. But are you in the buy anything and it's going to work right now, or are you a little bit more reserved?
Well, I don't think you should ever buy everything, right, Andrew? We know that yesterday was a real glass half full day. We've had a few volatile days, tough days. We had numbers out from both labor and inflation that were better than expected. So buyers took the opportunity to rush in. The earnings from the financial sector are good, stronger than expected. Strong banking. There's a lot of advisory business that's doing really well, deals. So, yeah, I think that this can continue today, and it makes people feel better about the concerns that have been weighing on the market.
But to the extent that there are concerns, and we're going to talk to somebody who's inside the Fed in the next hour about inflation, about looking at energy prices, you're looking at food prices. We can go through the numbers.
Sure.
Is that all still suggest to you? I mean, this goes back to the Ray Dalio comment that cash is trash, that you have to have it in the market. And then, of course, the question is, if that's the answer, where do you have it in the market?
So the struggle is, of course, the demand side is great. Demand on the consumer side, industrial, commercial, a lot of demand against inflation, tapering, COVID, China. What we feel is that it's important to be invested where bias toward growth. We like companies that can have some inflationary hedge in them. And we've had these rolling bear markets over the past year. Many sectors have come down 10+%. It's given us opportunities, despite the S&P being up 19% for the year and close to its all-time high. So the names we like, Netflix, Salesforce, CME Group because of volatility, Twilio on the high beta side, American Express, Visa, they get 1% of higher prices, American Tower, United Healthcare is a name we really like, and that was a good report yesterday. So there are opportunities out there where, we see inflation hedges built in.
Do you like the traditional banks? I know you just mentioned your version of financials sounded to me a lot like American Express and Visa, which is a different version of financials than a J.P. Morgan, a Bank of America, or Goldman Sachs, who we're going to be hearing earnings from very shortly.
Yeah, exactly. We also own Charles Schwab and Blackstone. Those are big positions for us. We do not own any of the big traditional banks. I think that they're showing strength better than expected. We don't own them because we think there are other opportunities. They're a little bit of the interest rate play. As rates go up, they go up, and we can play that also with Schwab. But if Goldman has good numbers today, which they probably will, I think you see another day of rally. And they're low multiple stocks, as we know.